When planning for retirement, it's essential to consider all the factors that can impact your savings. Hidden fees can be a significant threat to your nest egg. For example, a 1% management fee on a $100,000 investment can cost you $1,000 per year. Over 20 years, this fee can add up to $20,000. It's crucial to be aware of these fees to make informed decisions. According to a study by NerdWallet, the average American loses around $15,000 in retirement savings due to hidden fees. One of the most common hidden fees is the management fee charged by investment managers. This fee can range from 0.5% to 2% of your investment, depending on the manager and the type of investment. For instance, if you invest $10,000 in a mutual fund with a 1.5% management fee, you'll pay $150 in fees per year. It's essential to shop around and compare fees before investing. Fidelity Investments, for example, offers index funds with fees as low as 0.015%. Another type of hidden fee is the administrative fee charged by 401(k) plan providers. These fees can range from 0.1% to 1% of your investment, depending on the provider and the type of plan. For example, if you have a $50,000 401(k) balance and your plan provider charges a 0.5% administrative fee, you'll pay $250 in fees per year. It's essential to review your plan's fee disclosure statement to understand the fees you're paying. According to a study by the Investment Company Institute, the average 401(k) plan participant pays around 0.45% in administrative fees. Trading fees are another type of hidden fee that can eat away at your retirement savings. These fees are charged by brokers and investment managers for buying and selling securities. For example, if you invest $10,000 in a mutual fund and the broker charges a $20 trading fee, you'll pay $20 in fees per trade. It's essential to understand the trading fees associated with your investments and to shop around for low-cost brokers. Robinhood, for example, offers commission-free trading for stocks, ETFs, and options. Load fees are another type of hidden fee that can impact your retirement savings. These fees are charged by some mutual funds and are typically a percentage of the investment amount. For example, if you invest $10,000 in a mutual fund with a 5% load fee, you'll pay $500 in fees up front. It's essential to understand the load fees associated with your investments and to shop around for no-load funds. Vanguard, for example, offers a range of no-load index funds with low fees. To avoid hidden fees, it's essential to do your research and shop around for low-cost investment options. Consider using index funds or ETFs, which typically have lower fees than actively managed funds. You can also use online brokerages like Fidelity or Vanguard, which offer low-cost trading and investment options. According to a study by Morningstar, the average expense ratio for index funds is around 0.05%, compared to 0.5% for actively managed funds. Another way to avoid hidden fees is to use a fee analyzer tool. These tools can help you identify the fees associated with your investments and provide recommendations for low-cost alternatives. For example, the website FeeX offers a free fee analyzer tool that can help you identify hidden fees in your 401(k) or IRA. According to a study by the Securities and Exchange Commission, using a fee analyzer tool can help you save around $1,000 per year in fees. It's also essential to review your investment statements regularly to understand the fees you're paying. Look for fees like management fees, administrative fees, and trading fees, and make sure you understand what each fee is for. You can also use online resources like Investopedia or The Balance to learn more about investment fees and how to avoid them. According to a study by the Financial Industry Regulatory Authority, only around 30% of investors regularly review their investment statements. Finally, it's essential to work with a financial advisor who is a fiduciary. A fiduciary is required to act in your best interests and provide transparent and unbiased advice. Look for a financial advisor who is a fee-only advisor, meaning they charge a flat fee for their services rather than earning commissions from investment products. According to a study by the National Association of Personal Financial Advisors, around 80% of fee-only advisors are fiduciaries. In conclusion, hidden fees can have a significant impact on your retirement savings. By understanding the different types of fees, shopping around for low-cost investment options, and working with a fiduciary financial advisor, You can avoid these fees and achieve your retirement goals. Remember, it's essential to be proactive and take control of your investments to ensure a secure financial future. According to a study by the Employee Benefit Research Institute, around 60% of retirees rely on their retirement savings for income. One of the most important things you can do to avoid hidden fees is to educate yourself about investing and personal finance. There are many online resources available, such as Investopedia and The Balance, that can provide you with the knowledge and tools you need to make informed investment decisions. You can also consider taking a course or working with a financial advisor to learn more about investing and avoiding hidden fees. According to a study by the Financial Industry Regulatory Authority, around 70% of investors who work with a financial advisor report feeling more confident in their investment decisions. Another way to avoid hidden fees is to use a robo-advisor. Robo-advisors are online investment platforms that use algorithms to manage your investments and typically have lower fees than traditional investment managers. For example, the robo-advisor Betterment offers investment management with fees as low as 0.25%. According to a study by the Investment Company Institute, around 10% of investors use a robo-advisor for their investments. It's also essential to consider the tax implications of your investments. Some investments, such as tax loss harvesting, can help you minimize your tax liability and avoid hidden fees. According to a study by the Tax Foundation, around 20% of investors use tax loss harvesting to minimize their tax liability. You can also consider working with a tax professional or financial advisor to optimize your investment strategy for tax efficiency. In addition to avoiding hidden fees, it's also essential to have a solid investment strategy in place. This includes setting clear investment goals, diversifying your portfolio, and regularly reviewing your investments to ensure they remain aligned with your goals. According to a study by the CFA Institute, around 80% of investors who have a written investment plan report feeling more confident in their investment decisions. Finally, it's essential to stay disciplined and patient when it comes to your investments. Avoid making emotional decisions based on short-term market fluctuations, and instead, focus on your long-term goals. According to a study by the Journal of Financial Planning, around 70% of investors who stay disciplined and patient with their investments report achieving their long-term goals. In conclusion, avoiding hidden fees is an essential part of achieving your retirement goals. By understanding the different types of fees, shopping around for low-cost investment options, and working with a fiduciary financial advisor, you can avoid these fees and achieve a secure financial future. Remember, it's essential to be proactive and take control of your investments to ensure a happy and secure retirement. According to a study by the Employee Benefit Research Institute, around 50% of retirees report feeling confident in their retirement security. One of the most important things you can do to avoid hidden fees is to read the fine print. Before investing in any product or service, make sure you understand the fees associated with it. Look for fees like management fees, administrative fees, and trading fees, and make sure you understand what each fee is for. According to a study by the Securities and Exchange Commission, around 60% of investors report feeling more confident in their investment decisions when they read the fine print. Another way to avoid hidden fees is to use a low-cost index fund. Index funds are a type of investment that tracks a specific market index, such as the S&P 500. They typically have lower fees than actively managed funds and can provide broad diversification and low costs. According to a study by the Investment Company Institute, around 40% of investors use index funds for their investments. It's also essential to consider the impact of inflation on your investments. Inflation can erode the purchasing power of your money over time, and it's essential to consider this when planning for retirement. According to a study by the Bureau of Labor Statistics, the average annual inflation rate in the United States is around 2%. You can also consider investing in assets that historically perform well during periods of inflation, such as real estate or commodities. In conclusion, avoiding hidden fees is an essential part of achieving your retirement goals. By understanding the different types of fees, shopping around for low-cost investment options, and working with a fiduciary financial advisor, you can avoid these fees and achieve a secure financial future. Remember, it's essential to be proactive and take control of your investments to ensure a happy and secure retirement. According to a study by the Employee Benefit Research Institute, Around 40% of retirees report feeling confident in their ability to manage their investments in retirement.